Well, hello and welcome to this week's review at the Rice CFP Insurance Program. We're going to focus on, actually I'm going to make two videos. This first video will be focused on annuity, all the content we went over last night related to annuities. And then shortly after I will create a video to kind of preview the health insurance review. And to do that, I'm going to use my very cool flashcards. At least that's my plan here. So last night in class, as we studied annuities, I reviewed some of my annuity review flashcards. What I'd like to do now is take a look at a little bit broader set of flashcards. So you may know I have multiple sets of flashcards, and I'll be using the old school, the flashcards that I create in my digital resource. It's the insurance planning course that the same textbook you're using, except I'm using a digital version. And I've created flashcards. So in class, several students let me know that you would appreciate if I share my flashcards with you. So I'm going to do that in this video. And I wanted to make a quick announcement before I do this video on annuities and the next video on health insurance, the preview video. I wanted to just kind of share, if I can find it. So I've found this cool tool called Quizlet, and it's free, and it creates flashcards. But what's really cool about Quizlet, I think it's cool, is that it allows me to create flashcards, sets of flashcards. It allows me to invite students to come to the course. It also allows me to share a link that will let you opt in yourself to view these flashcards. So I hope that's helpful. That's my solution for delivering your request. So I hope you like it. I hope you take advantage of it. If that doesn't work, I'm not sure what I can do other than just maybe, like I said in class, let me just make this clear. I think flashcards are awesome. I think my flashcards are especially awesome because I've taken the CFP exam and I actually passed it the first time. And the way I did that was I created about 1,000 flashcards at least. And the way I did that was I created flashcards that were taken from, the many banks of questions that I practiced in preparation for the CFP exam. And so that's what I've done for the flashcards I've created to review with you in class. Is I've gone to the test questions. I have many banks of test questions, and I've tried to identify those topics that I think, based on my experience, based on my review of this course, based on my preparation for teaching insurance at the Rice CFP program, based on all of that, I've created sets of flashcards for you, really for me as well, to prepare for teaching the course. But they're primarily flashcards that I think can help you prepare for your quizzes, your midterm, your final exam in this course, because those are very important for you to get good grades on your quizzes, your midterm, and your final. But more importantly, or at least equally as important, is to pass the CFP exam. So my primary focus, I would say honestly, is to try to help prepare you for the CFP exam. And that's what these flashcards are all about. So all that to say, I would encourage you when I share this link, and I haven't checked with management to make sure this is copacetic and cool, but I'm hoping and pretty sure it will be. I'm just going to be creating my own flashcards to share with you, but here's what I'm going to ask in return. This tool, Quizlet, It's free. I've paid for the teacher version, a premium upgrade, so I have the pro version, which means I can create classes and I can create sets and I can invite students and I can build a community around this educational process. But what I'm going to ask from you is that you'll commit to create your own flashcards and share them with me and with the other students, and let me use this as a tool to create a pretty good storehouse of questions using flashcards, not questions, but that's what I'm using, is the questions to create the flashcards. And I want to encourage you to join and participate, use the resource. I think it will help, but also to share and help build it. So if each of us, committed to creating even 5 flashcards, the things that you struggle with, that you want to help the other students learn. If we all created 5, there's like 35 of us in the class. So do the math. I'm really not good at math, but 5 times 35 would be somewhere, it's like half of 350. That's a lot of flashcards and more than we need. So I'm committed to creating at least 200 flashcards. And I could use a little help just to make sure that I'm not missing the topics that you think are most important. So let's jump in and do a review here. Again, I'm going to do a flashcard review of the flashcards that I think are going to help you with your midterm. And so these will focus on annuities. You can see here I can tell myself if I know it or don't know it. And that's obviously a tool that a flashcard program or app can give you. So by using by signing in and using these flashcards in Quizlet, you can have the same opportunity to kind of track yourself. And it even lets me see how you're doing. So not sure how much I'll use that, but enough said about Quizlet. Now let's jump in. Variable annuity losses. So this question just focuses on, what's deductible if you have a loss in an annuity, a variable annuity. It can't be deducted. Even if the annuity is exchanged for another annuity, you can't deduct the losses on an annuity. I didn't really think about that until this week, but I thought I'd share it. IRD assets. So assets are classified a certain way in estate planning. And in estate planning, an annuity asset is considered income in respect of a decedent. So IRD, they're considered IRD assets. We have a lot of questions and a lot of information about COBRA, so let's talk about COBRA benefits. The recipient must pay the full cost of coverage plus up to 2% of the premium to COBRA. And it requires certain employees to provide previously covered employees or certain employers to provide previous covered employees with the same coverage. That's the whole big idea of COBRA. Employers have to offer coverage for 18 months if the employee is terminated. And I have a question mark there, not because I'm not sure of the answer, but we have to make sure we understand as we look at these questions, what was the cause of the termination? That will affect whether it's 18 months or 36 months or less. So let's just make sure we pay attention to that. NAIC, we haven't talked about that much in class, but it's the National Association of Insurance Commissioners, and they accredit state insurance departments. So the NAIC is a national group of commissioners, a body of smart people, and they encourage exchange and dissemination of information among the states. And the NAIC members are state insurance commissioners. So Texas has one, California has one, and they are, I believe they're elected, the commissioners. They have no legal authority to enforce their model laws and regulations. They just kind of provide direction and leadership and information. Major medical example. Now, by the way, I shuffled these cards, so we're going through them in a random way, and you'll notice we're covering more than one topic here. In this set of flashcards, what we're doing is we're covering insurance, we're covering annuities, and we're even covering a little health insurance, which we haven't actually gone through in class. So this set of flashcards will have everything, hopefully, or at least it'll have a good sample of what you'll see on your midterm exam. So let's take a look at a major medical example. In this case, I used myself and my wife. We're married, we have 3 kids. We have a comprehensive major medical policy. We have a $200 deductible per person, an 80-20 co-insurance provision, and an out-of-pocket max of $3 grand. And I broke my leg in October, needed surgery, and it cost 35 grand. Myself and Connie and each of our kids have an annual physical exam early in January, which costs $250. And aside from these expenses, there were no other health costs incurred by our family this year. So how much am I going to have to pay? I'm going to have to pay $2,000 out of pocket to cover the cost of my surgery. So I'm not going to walk through how this was calculated. The main point of this flashcard is to see this question and to recognize that this is a very likely question that you'll see on your exam. So we can talk about it and work through it, but I would encourage you to sit down and think about how you would answer this question and how you get to that answer. So health savings accounts, another topic we haven't really talked about. I like health savings accounts because the contributions are tax deductible. And you may recall I was born on April 15th. My first child was born on December 31st, which meant I got a tax deduction without ever taking him home. And so that's why I'm a financial planner. That's not true, but tax deductions are really helpful, and an HSA gives you one of those, and it lets the money grow in a tax-deferred way. So health savings account is a topic you could very well see on a test. Annuities, now we're jumping into annuities, they mitigate 3 types of risk. So annuities have advantages, including mitigating or reducing 3 kinds of risk: market risk, superannuation risk, the risk of growing very, very old, and also purchasing power risk. So we've talked about that in class. This is really focused on a fixed annuity because market risk is not avoided if you have a variable annuity, which is one of the topics that we covered considerably. A cross-purchase question. Here's a question you could see, and this one always gives me a little trouble, but you have a partnership with 5 partners, and they're going to use a cross-purchase buy-sell agreement, which provides coverage upon the death of one partner. So the remaining partners have to buy the deceased partner's interest, which means they each have to have a life insurance policy. If you're setting this up for a client, one of the nice things is it involves a lot of policies. So if you happen to be a State Farm agent, which I was when I did my first cross-purchase buy-sell, it racked up a lot of nice applications. In this case, with 5 partners, it would be 20 policies. There's a formula to calculate that, and you will want to know how that works. Company strength ratings, we've talked about this in life insurance as well as annuities. A lot of times clients don't realize how important the strength, financial strength ratings for companies are. And as certified financial planners, it's one of the areas that we need to focus on before making a recommendation. If you're in the business of making recommendations for insurance, which I am as a certified financial planner, I think it makes a lot more sense to help serve my clients in that area as opposed to sending the policy proposal and process off to someone else who just may not have the same level of commitment to my clients as I do. So I know there's a little controversy about selling life insurance and annuities when you're a CFP, but my sense is it makes sense. And so knowing the strength of the company is one of the variables, one of the metrics, one of the things that I need to vet before making a proposal. And so these are the 3 groups that do the ratings. Buy-sell agreements for life insurance. Another question you could see on the test. The following are true concerning the use of life insurance to fund business continuation agreements, also known as buy-sell agreements. Insurance protects the seller's heirs from the inability of the buyer to pay the purchase. That's true. Insurance lessens the likelihood that the buyer will look for ways to get out of the purchase obligation when it comes time to pay. So if you think about the idea of a buy-sell agreement, it protects the business owners' families. And it can also obviously protect the partners and the other folks in business from significant disruption. The truth is, so many business owners have not done this type of planning. So it's an important topic, and it's very likely to be on your CFP exam. So we have to understand what happens in the sale or transfer or exchange of a life insurance policy. And that's what this question addresses. So the sale or other disposition of a life insurance policy at a gain is generally a taxable event. And an exchange of a whole life policy for a universal life policy. Let's see, what is the question here? Okay, so yeah, if you exchange a whole life policy for a universal life policy, it is going to not be recognized. Oh, the question is, I'm confusing myself here. So one of these is not recognized. And the exchange of a whole life policy, as I'm reading that, would, if you could exchange that for a UL, that would not be a taxable event. A transfer of a variable life policy to a former spouse pursuant to a divorce. I'm not sure about that one. I think not. I think that is not going to be a taxable event. An exchange of an annuity contract issued by one insurance company for an annuity contract issued by another insurance company, that is not a taxable event. A viatical sale of a policy by a terminally ill insured policy owner, that was one of the kind of exceptions. If they're terminally ill, it's not a taxable event. An exchange of an annuity contract for a variable universal life policy is recognized. And again, that's just, think about, there are certain rules about transferring the 1035 exchange, and because that last item is the exchange of an annuity for a life insurance policy, that would be recognized as a taxable gain, assuming there was a gain there. Tax treatment of whole life insurance. So this is another question you're going to see. The tax treatment of a whole life insurance is favorable for several reasons. The investment earnings are generally tax deferred. Premiums paid by the owner can reduce a taxable gain that may occur at surrender. And the death benefit received by the beneficiary is typically, almost never, subject to federal income tax. That's almost always true, and we'll talk at some point about business applications where that might not be true. But for the huge majority of folks, the death benefit of a life insurance policy is free from federal income tax. However, dividends received by the owner are taxable. I know that. If you have a policy that's participating, and that's not on this flashcard, but that's, if you see the word participating, it means the policy is receiving dividends, and those dividends are taxable. So moving right along, this one has given us trouble, the human life value. It is one of the items that the CFP board likes to test on. So just know it starts with a present value, and it's looking for a future. So the present value of a family share of a deceased breadwinner's future earnings. That's probably going to be the most complicated definition you see in a question, and there's a formula for calculating that, which we went over in class. But just know the human life value, the definition. It's an easy question to get if you just take a look at your flashcard every once in a while. Annuity settlement options. So here we have Jimmy funding a life annuity through installment payments, and at age 60 he decides to elect an annuity settlement option and begin to receive payments. Life income with payments guaranteed for 15 years would result in the lowest monthly income compared to these other options. And I'm not going to read them, I'm just going to point out that this is such a common area of counsel for clients. And if you're a certified financial planner, one of the things you got to be very comfortable with is helping folks understand when they get ready to take a settlement option in an annuity, how that option is going to affect the monthly payment. And it makes a lot of sense if you just realize that the more guarantees you get, the less payment you're going to get. And that's what this question is focused on. And you will see this type of question, and you will also see this, this planning application come up with clients all the time. So just know how that works. Some quick annuity facts. A life annuity with a period certain ensures that the annuitant receives a minimum number of payments or will have lifetime income, whichever is greater. That's the life annuity with period certain. That period certain would be a guarantee. So that would reduce the benefits as opposed to a pure lifetime income policy. And an installment refund annuity, the insurer, the insurance company, promises to continue periodic payments after the annuitant has died until the sum of all annuity rent payments equals the purchase price of the annuity. Next, a joint and survivor annuity. That's an annuity based on the lives of 2 or more annuitants. And we talked about that a couple of times in class. And I told this story about how my dad worked for Oldsmobile. My dad passed in Easter this year, and I thought, we talked about his pension, and basically a pension is an annuity. You make a selection the same way you do on an annuity. Dad selected to have the benefit that he was receiving also go to my mother, but the choice that he made reduced that benefit. So Dad lived a long time. He received a much higher payment. That worked out really well for him and Mom. However, once he passed, Mom's benefit was a little less, and that's joint and survivor, and that's how that works. The pure life annuity is not best for the person who has several living dependents to whom he or she wishes to leave assets. So for example, if you have a lifetime income, that's the settlement option you chose from your annuity, and then you happen to die 2 months or 6 months after that annuity starts to pay out, the insurance company keeps the money. Your beneficiaries receive nothing. So that's just something to be aware of. Variable annuity tax example. I'm not going to go over this all the way through, but just want you to know that variable annuity and tax consequences are something you could see on the exam. In this case, the payments are going to be totally ordinary income because I've received back all of the investment in my contract. So be aware that's just kind of how it's going to work with variable annuity. When you receive benefits after exceeding your life expectancy, the benefit payments will continue and will be variable depending on investment experience. But the payments will consist entirely of taxable ordinary income because I've already received all of the investment in my contract. And that's the way all of these are going to work basically. We talked about this in class. Your basis, however many dollars you put into the product, you can get that back tax-free, but anything over that is going to be ordinary income, which is the worst kind of tax to pay, ordinary income. Annuities are, here's some fast facts about annuities. In some ways, they're opposite of life insurance. So let's not get confused about that. Typically, annuities are sold by life insurance companies, and the truth is they're kind of opposite from life insurance. The fundamental purpose of an annuity is not to replace lost income in case of premature death. That is a trick question, so if you see it, just know that's true. Annuities, the purpose, that's the purpose of life insurance, not an annuity. The main purpose of an annuity, well, there are several. We'll go over the advantages and disadvantages of an annuity. Equity index annuity. This is an area that this is relatively new, and so I don't know what to say about this except that an equity indexed annuity it's a relatively new product. There's a maximum percentage gain, so it's usually capped, It's tied to an index, usually the S&P 500, but the owner of the annuity typically does not get the full benefit of the performance of that index. They're capped, and there are minimum guarantees. It's a fixed annuity. It's not a variable annuity. So just be aware of what it is and a little bit about how it works. I don't think you need to go too deep into it in terms of preparing for your exam. But obviously if you're selling equity index annuities to clients, you need to understand it much better. I'm about to do an illustration for a client, so I'm going to learn a lot more. I've never actually sold one of these products, but I've been eager to, find someone who needed that because it's an interesting and very popular product. Wasn't available when I was at State Farm. It's not available to State Farm agents to my knowledge. So, major medical policy payment. Here's a question that deals with a medical policy and what's going to pay. So Sally has a major medical policy, $250 deductible, 80% coinsurance. Total medical expenses during the year, $39.50. What's her share of medical expenses for the year? So just remember, it's 80% coinsurance. That's what the company's going to pay. She's going to pay 20%. And don't forget to apply the deductible. So you do the math, you come up with $990, which would be 20% of the $39.50 less the $250 deductible. Medical expense insurance. Traditional forms of medical expense insurance cover surgical services of a physician, nursing services, laboratory services, and never nursing home custodial care. Big trick question that you may see, but more importantly, it's something you need to understand for the purpose of helping your clients prepare for the big risk, which is long-term care. So we've got 36 more to go. Flashcards. I'm going to try and hurry up. Second to die, that's an estate planning tool. Don't fall for the trick that it pays half the death benefit at the death of the first person. It's a policy that pays after the second person dies. Life annuity with no period certain. This is the big risk, and the house can win if you don't live very long. Stop loss coinsurance, that's just, you need to know how that works. A stop loss is a maximum coinsurance provision, so after at some point your coinsurance, you have a max out of pocket, and that's what the stop loss is. Major medical example, another one that just shows you how to calculate what will the client pay in the event of a loss. Practice some of those if you haven't got that one down. Know what a PPO is, and know a few of the facts about a PPO. That'll be on your quiz, I'm sure. Variable annuity taxation question, we've already gone through one of these, but remember, we're always going to be looking for the basis and what is recovered beyond what you've paid into the product, and that's always going to be ordinary income. So that is that. Structured settlements, we've talked about that a few times. Structured settlements are generally a way to use an annuity. An insurance company that's settling a claim would offer a structured settlement that would give the client a longer payout with probably more dollars to receive over time as opposed to a lump sum. And so it's very similar to when you cash out of a pension plan at work. You have the option to take a lump sum, or you can take an annuity payment. That's what a structured settlement is. An annuity income tax question, again, this is something we calculated in class, and I'm not going to go over that right now, but it's something to know. Types of annuities. These are, 4 types of annuities. What's a temporary annuity? I'm not sure. I put question mark there because I'm not sure. But I saw that in a question, and it's a type of annuity. So straight life annuity, we all know what a straight life annuity is. So I'm not going to jump into that question. Another annuity question, what is it? A typical high earning client should consider the purchase of annuities having which of the following characteristics? So this is a question you're likely to see, and it's just basically testing to see if you understand the different characteristics of an annuity. In this case, this client, high earning client, they'd want a deferred annuity so it could grow tax-free, and they'd want something variable so that they could take advantage of the higher growth opportunity in the market, which is what a variable annuity would do. Qualified viatical settlement. Not going to get into that right now, except to say you could see a question on viatical settlements. What is a universal life policy? UL stands for universal life policy. The key word there is flexible. That's the first thing and the best thing to know about a UL for the purpose of the test. Anytime you see variable, in this case it says variable universal life, you know that it's not a fixed account. It's one that the client takes the risk. There are lots of fees, but it's universal, which makes it even more expensive in terms of fees. So that's just, we've gone over that in class. Reduced paid up insurance is a great way to get a settlement offer. So this example just says, I've got a policy, I'm old now, I don't really need it, everything's paid off. So instead of just canceling the policy, a non-forfeiture option would be to employ, could be reduced paid up life. Just means I get to take that policy cash value, and instead of just cashing it in, I can get paid up life insurance, which can be a very valuable something, instead of just forfeiting the policy, taking a cash value. Life beneficiary rights. So know the difference between a revocable and irrevocable beneficiary. That changes the rights, and I'm not going to spend much time there. I'm going to try and get through this pretty quick. 4 types of life insurance: universal life insurance, whole life. We have the word participating. I'm reading from the bottom up here. Participating means it gets a dividend. Variable universal life, it's like a mutual fund. It's not guaranteed. Level term insurance, the simplest and usually, well, the most inexpensive of all types of life insurance. So those are the 4 types of life insurance. Hopefully you know those. This question, universal life characteristics, very flexible. That's what you're looking for. It doesn't guarantee a minimum cash value. That's important to know. Reinstatement clause, not going to get into that right now. Settlement options in a universal life policy. There are 5 listed here: cash value option, fixed period, interest, fixed amount, lump sum. So it's like when you get ready to have, if Connie owns this policy and she pre-selects a settlement option for her beneficiary, in this case her daughter Carissa, these are the options for how that policy could pay out at Connie's death. So know what those are. Settlement options. Calculating human need, we've talked about this. There are 3 ways to do it. Well, this is actually the formula for the human life value. It's a little complicated, but there is a formula for that. You might want to, you should know how that works. Life ownership. Which of the following are true regarding the ownership of a life insurance policy? The policy owner can assign or transfer the policy to whoever they choose, even if the assignee has no insurable interest. And these are just shows a couple examples of what you might see on an exam that are wrong. A policy can only be issued to the insured. That's certainly not true. Generally, assigning a policy requires proof that the insured is still insurable. That's not true, obviously, based on the first statement. And only a person with an insurable interest, generally a relative, lender, can be named as a beneficiary, and that is obviously not true. Here's some facts about underwriting that we went over. I'm not going to spend any time there now. Severity and frequency. These are pretty common on the test, pretty general, pretty easy to understand. So severity and frequency of losses, that's general insurance information. Law of large numbers, this is another they like to ask this question. The larger the number of exposure units insured, the closer the actual losses will be to predicted losses. And all of these facts around the law of large numbers and severity and frequency, they all have to do with how does an insurance company charge, how do they figure out what's an equitable, reasonable, fair amount to charge. Insurable interest, we've talked about that a couple of times. Just remember, it's different from property and casualty and life insurance. You have to have insurable interest on a life insurance policy at the inception of the policy. On the other hand, with a property and casualty policy, you have to have insurable interest both at the time of the application and at the time of the loss. So just know that. Insurable interest. Variable annuity, not going to do that. Not going to do that. Life surrender, not going to do that. We're going to run out of time. Surrender cash, too much information. Bill has a life insurance policy with $250 face amount, $55,000 in cash value. Annual premiums $2,400 and a loan of $25,000. Bill has paid 14 years of premium. Susie has a life insurance policy with a face. I'll let you read that. Which of the following events result in taxable income to Bill and or Susie? So this is the type of question you'll see on the exam, and they will list, did I not? Yeah, I don't know what, I didn't include the answer, but that's just, I wanted you to see the kind of question that you're very likely to see on your quiz, your midterm, and also on your CFP exam and your final. So that's a lot of information. I'm not going to spend time right now going over it, but I wanted you to see it. Surrender for cashness in a permanent policy. Here's another one of those examples that you will see on a test. So I'll let you look at that for a second, or pause your screen and then move on. Lifetime income versus cash. We've already talked about that. The lifetime income provides protection against that superannuity. Yeah, if you live to be really long, this is the best protection against that lifetime income, the lifetime income option. FSA, it's like an HSA, but it's FSA. It's much more restricted than a health savings account. And so just be familiar with what it is. This is an example of how it works, and you'll see this in your book. I'm not going to spend time on that right now. That was the question. This would be the answer. I'll let you see the answer there. And I'll show you the question again so you can take a screenshot. Take another screenshot of the answer. And then we move on. FSA question, that's another question you could see on an FSA. And that was that deck. Now that deck was actually, remember, those flashcards, while this is the review of annuities section, that deck that you just saw covers both annuities and health insurance and the introduction to insurance and all of the other things that we've covered so far. But it included annuities as well. I could do the annuity cards, but we did those last night, and I'm not going to do them. Well, what I'm going to do is in the next video, I'm going to show you the flashcards that I've created using the new tool you can see here. I have 0 cards created for health insurance because I'm using this new tool now. So I've created some flashcards here. I'm going to do the next video on health insurance, and I'm going to include the cards that I've created so far. So I'll see you on the next video. Sorry this one was so long. I hope it was helpful, and we'll see you soon.